Welcome to this latest edition of Citrus Insights. This is the latest of my recent interviews designed to provide helpful information during this more, it's called volatile market and somewhat unclear economic period. Today, I'm absolutely thrilled to be joined by Lindsay James, investment strategist and media spokesperson at Quilter Investors. Lindsay joined Quilter as an investment director in 2019 before becoming an investment strategist responsible for providing external commentary on the markets, speaking to the national press and media. She's a regular on Sky News, the Today programme, Wake Up to Money, and CNBC Europe, to name a few. So clearly a very trusted voice. Lindsay, it's great to see you. I'm thrilled that your journey with all of those other news channels has brought you to, no doubt, the pinnacle of your career today with the chance to talk with me and our viewers. So welcome.
Thank you. It's a pleasure to be here.
And Lindsay, look, in preparing for today, I rewatched some of your videos, actually, one of which was, I think, from March. And it was on CNBC when you were interviewed by Karen Cho and Steve Sedgwick. And I think it was sort of, the interview was mainly about the German financial package. And you were talking then actually about some of the potential US economic weakness. But it struck me, I think the video was only sort of, the interview was about 5 weeks ago. And I just sat there thinking, oh my days, how much the world has changed in a 5-week period. So I'm going to try, in the essence of time, I'm going to start with tariffs today. And there's been so much talk of tariffs, and obviously the introduction of them, the backtracking of them. They're up, they're down, they're paused. So maybe we can start with, where do things currently stand?
Okay, yeah, sure. So first of all, we have a baseline tariff from the US of 10% on all imports. They've suspended the idea of their reciprocal tariffs for 90 days pending negotiations. So that will take us to July the 8th. And we hear snippets about how those negotiations are going. I think the reality is that a trade deal tends to take 2 or 3 years, and it's done with a huge team of people involved. They've got 84 countries to work with in now just well under 90 days. I think almost a month has passed since Liberation Day now. So the reality is that's not going to happen. It's going to have to be a more wholesale approach taken. The other tariffs that we still have in place are on the auto sector, 25%, and on the metal sector. There have been a few carve-outs from these already. So, for example, Mexico and Canada have benefited from carve-outs on all their products, which had faced 25% tariffs across the board for anything covered by the USMCA agreement. So there's been some moves already on the tariff levels imposed. But generally speaking, it's this baseline tariff that makes up the largest part of it. Now, China hasn't escaped as easily. There's a tariff of 145% now when you add up all the different layers of tariffs that have been put in place on Chinese goods. Now, that means effectively there's a trade embargo between these two nations. I think the US is starting to realize that this is going to be really damaging for their economy too. When we think about rare earths, these are important minerals that go into production of defense equipment, renewable energy, medical purposes as well. Around 80% of the rare earths the US uses come from China. Similarly, with consumer electronics, about 90% of consumer electronics come from China. So they're starting to realize this embargo is going to be really disruptive, and they're already making noises about trying to address this tariff level. China doesn't want to know anything about it yet. They're the ones playing hardball. So we're going to have to wait and see how this evolves over the coming months. But that is currently the way that the land lies.
Okay, and well done for keeping up to date with all of that. And I suppose one of my when I was hearing about it, the concept for President Trump was that, well, actually, over a period of time, these goods can be produced in the US. But actually, everything I hear says, you can't turn a tanker like this. It's years and years and years to build just, warehouses, to build manufacturing, to build the skill sets and all of that. So actually, I just wonder if the awareness is there that actually so much of this is going to be really hard to achieve when it comes to the production of this stuff in the US anyway.
Oh, completely. Michelin, the tire manufacturer, have already said that to open a tire factory in the US would take them about 3 years and about $600 million. That's before they even produce one tire. And we have to remember that the US is a higher cost jurisdiction than the places where these manufacturers already manufacture their goods. So not only have they got this big upfront cost of doing it, a very disruptive process as well, but at the end of the journey, they're going to have to work in a higher cost environment. So given Donald Trump's got 4 years in the White House and could possibly have his feathers clipped a little bit at the midterms, they might just decide to wait it out. But some companies are already making noises about increasing their manufacturing exposure to the US. We've had JCB in the UK as one of these companies. There's also Roche as well, talking about really expanding in the US. So I think it's really going to depend on the company and how much exposure they have, how difficult it is to shift that manufacturing. But by and large, yes, it's not an easy process and not a cheap one either.
And why do you think it strikes me, during the campaign, the election campaign, the presidential campaign, this was talked about. So Trump talked openly about tariffs. Why were the markets caught so off guard when this is something that was talked about so much?
Well, I think there's two main reasons. The first was the really simplistic and blunt way in that reciprocal tariffs were actually calculated. So it was done based on the level of trade deficit that they have with a particular country. So any country that actually exports more than it imports from the US was penalized. And poorer countries typically have the highest trade surplus. So they export goods like textiles and they import only very limited quantities of US goods. They're typically quite high value goods that come out of the US. So they got clobbered the hardest. If we look at Vietnam, for example, the average wage there is about $700 a month. And yet they face a 46% tariff because they are big exporters of textiles there. That's partly because Chinese companies had already diverted their manufacturing away from China to avoid tariffs through economies like Vietnam. So this is partly why the US is trying to hit them quite hard. But really, it was a very blunt way in which they went about it. Israel, apparently, one of the US's greatest allies, they had already rolled back all tariffs on the US, and yet they were facing a 17% reciprocal tariff. Japan similarly had rolled back a lot of their trade barriers. They sent a delegation to the White House in March. Fat lot of good, it seemed to do, because they got a 24% tariff. So this kind of added up to investors thinking, what on earth can these countries actually offer to see it roll back? So that was the first point. And secondly, I think the overall level of tariffs was a lot higher than investors were expecting. Before Liberation Day, the average tariff level on US imports was 2.6%. Even now, if we put the reciprocal tariffs to one side, it's 28%. Now, I would imagine there'll be a lot of adjustments in purchasing patterns. For example, people won't actually pay 145% tariffs on Chinese goods. They just won't buy any, or they'll buy from other sources where they possibly can. So if you factor in all those behavioral adjustments, it brings that effective tariff rate down to around 11%. But there's a lot of assumptions built into that. Either way, it's an awful lot higher than it was on April the 1st. And I think that's the factor that really has caught investors by surprise.
Okay, interesting. And ahead of that, did we see some companies go, well, actually, I can beat this if I think there's going to be a tariff, so I'm going to absolutely try and ship as many goods as I can into the US prior to the tariffs being announced? And actually, does that kind of work in so much as those are excluded because they arrived in the US prior to kind of the whole communication starting about tariffs?
Yes, they did. So we're going to really see that coming through in the Q1 GDP numbers out of the US. And actually, it's going to make it look worse, conversely, because when you have a very high level of imports, it actually drags down your overall GDP growth calculation. So for some companies, they'll have done quite well out of it. We can look at the car industry, for example, and see that the sales of cars in the first quarter were very, very high in the US because people wanted to get ahead of the tariffs. But I think it might mean the GDP growth numbers look actually pretty weak. So it will have really manipulated consumer behavior and made the numbers even harder to try and sort of see through in terms of getting a picture of what the long-term trend is likely to be.
Okay. And then, so, clearly almost leading up to the announcement. And then following the announcements, we saw equity markets fall off quite heavily. Some have bounced back at this time to a certain degree, but clearly the fall was quite sharp. Bonds fell. I think the dollar fell. Dollar's been so strong for a while, and that weakened, which seems quite unusual. So, given everything we've talked about, why did it hit so hard, and why were so many areas impacted by the falls?
Well, first of all, the tariff level was pretty much higher than people were expecting. Tariffs generally act to reduce growth and also increase inflation. They create this scenario where even though you might have unemployment picking up and growth slowing, the central bank can't really act to cut rates because they've got an inflation problem, and price stability usually supersedes full employment in terms of their priorities. We've also seen treasury yields moving higher, making financing more expensive for companies. Now, usually higher yields would attract in foreign investors into the currency markets as well. So you would tend to see a dollar strengthening. And we saw that prior to Liberation Day. The more we heard about tariffs, with investors expecting some kind of genuine calculation of a reciprocal tariff, we didn't get that. But that was sort of starting to support the dollar if we look at the back end of last year and the beginning of this year. But actually, the result we got was so different to what people were expecting. With yields moving higher, there was actually people moving out of the dollar, which is quite a warning sign. It's really saying that investors think policy making has gone wrong, and they just don't have the confidence to back that part of the market. It's a classic sign of market stress. But I think it's important to recognize as well, this has not all been moves in one direction. We've seen markets now back where they were at the day after Liberation Day. So although we had sharp falls in the week or so afterwards, a lot of that has now been recovered. The US market is still down about 12% year to date, but half of this is actually down to the dollar. So, it's not all been about a weakening of the corporate outlook. Similarly, US Treasury yields are still lower than they were at the start of the year. Now, they rose very sharply at the start of April, but they've retraced pretty much all of that now. And so I think it's a reminder that when we get these very sharp moves over the course, usually it's a week or two, the next phase of it is usually some kind of a reversal of that. So really important to remember not to be panicked out of it, because you could quite possibly be selling at a low point. We've also seen some other trends emerging. So German bonds have become more of a safe haven asset than US Treasuries now. And that's quite surprising when you think about the big changes we've seen in Germany as well, when they've expanded their appetite for taking on government debt in order to invest in defense and infrastructure. Initially, we saw German bond yield spike, but all of that has been retraced, and some. So I think this could well be one of the new safe havens for investors.
Actually, that's interesting. So maybe as you talked about Germany, let's come on to Europe for a second, if I may. So it feels like for a while Europe's been seen as, actually from a growth perspective, kind of nothing particularly exciting. Is this a chance potentially? And in fact, leading up to this, I think a lot of the general view over Europe was the difficulties of Europe working together. But actually, could this work in favor of Europe in terms of, China's still going to be producing these items, and frankly, they're probably going to need to be sold somewhere. And clearly, if they're really expensive in the US, if that were to happen, Europe's probably a good place for these items to end up, isn't it?
Well, China might think that, but I think what we would actually see is the anti-dumping measures that the EU has already imposed on a few areas that could well be expanded. They don't really want more cheap Chinese goods, to be honest, partly because inflation is no longer the issue it was in Europe. It's now pretty much back at target. And that's one of the reasons we've seen rates coming down in Europe and are likely to continue coming down. Market expects interest rates to only be at around 1.5% by the end of the year. So there's no real inflation problem that Chinese goods can solve. There's a growth problem. And again, if you have those Chinese goods coming in, it's going to hamper the growth of domestic EU companies, and therefore hamper the tax revenue for those governments. So I don't think they'll see that as the solution. Growth is still an issue in Europe. They are effectively, if you think about their manufacturing economy, as almost an assembly line where they bring in cheap parts from China. They then assemble based on their add-on of sort of innovation and design, and then they export to other developed markets. The US accounts for about 20% of those exports. So they do get they do get hampered by any kind of disruption in trade between the US and China. And we've already seen Germany marking down their growth forecast this year back to 0%, unfortunately. But it was only expected to be around 1% just before this tariff kind of upset has come through. But it's different when you look at the equity market, because the equity market is forward looking. It looks at a much longer term trajectory, and therefore we've still got European equities performing well, up around 6% so far this year. And that's partly because the valuations are more attractive, and partly because we do now have a different tone coming out of the EU. They're working together a little bit more effectively. We've seen decisiveness coming around increased defence spending. And in Germany, this complete change in policy making, which means they're going to invest up to €1 trillion now in defence and infrastructure. So I think this is starting to make investors feel that perhaps, this might be too early. I might be too optimistic here, but perhaps they're finally starting to get it together. Now, they're not bad in a crisis in the EU, and this is a crisis for them. And it does look like they are starting to recognise really the threats to the economy there and acting accordingly.
Okay. And does that, on that basis as well, when you think about, and I know the term Magnificent Seven, and I always find it quite difficult talking about Magnificent Seven because I think the businesses are so different in terms of, what they are. But, do you think it's the beginning of the end for the Magnificent Seven?
Well, this has been a popular view, I think, in recent weeks. Now, it's probably a bit of wishful thinking as well from active managers, if I'm honest, because, of course, there have been big drivers of market returns in recent years. And almost any active fund has been underweight the Magnificent Seven simply because of the concentration that they have in the US index, accounting for around 25% of it. But the reality is it's going to come down to their fundamentals. Now, we saw strong results coming out from Alphabet, the parent company of Google, last night. And we're heading into earnings season now. So we're going to get a clearer picture in the coming days. They have been the fastest growing parts of the market in recent years, but that growth was expected to slow down in any case. So I think there was already this view that fund managers were going to have to find other ideas. There were going to have to be other strings to their bow because they were slowing their growth, and there were other parts of the market that were cheaper and actually starting to look like they would be growing even faster than the Mag 7. So they were underperforming even before Liberation Day, in fact. Now, in the first quarter, they fell about 16%, so more than twice the index. And through to couple of days ago, they were down as an equal weighted index, down about 27%. So they've fallen a long way. And I think we can't lose sight of the fact that these are still very good businesses with very high profit margins as well. So why have they been so weak? Well, very briefly, Chinese competition. We had the announcement of DeepSeek, the AI model that came out of China at the end of January, really showing that there could be huge leaps forward in AI innovation without having the most expensive, latest chip from NVIDIA. So that really showed that moat that was perceived to be around the company really was under threat. So more competition from China, number one. And then secondly, I think we've seen that when they've announced their earnings, they've kind of been in line with what the market was expecting. Now, there had been years and years and years where they kept announcing better earnings than were expected, and also announcing forecasts for the future that were also stronger than analysts had in their models. Those days are over. Analysts have really cottoned on to the opportunity here now. So the stock prices were pretty much up with events. And then I think the final thing is just that with a potentially cyclical slowdown already overdue in the US, now we have the tariffs potentially upsetting the economy further. Investors are really preferred to find cheaply valued companies that are also likely to be very defensive. That's why the utilities sector was actually one of the best performing areas in the first quarter. So they just don't sit in that part of the market that investors are really attracted to either at the moment. So I think in short terms, answering your question, I wouldn't write them off. There's some great businesses within that mix, but equally, they've got a lot of headwinds at the moment too.
Okay, thank you. And in the time we've got left, I just want to kind of come back to the UK for a second. So I think the US is the biggest export market for the UK. So it feels I guess, are we more vulnerable as the UK? Are we more vulnerable to what might happen in terms of the disruption? And from a, I'm conscious that most of what we export is actually services. So I'm not entirely sure how much the tariff piece impacts that. So it'd be great to get your view on that.
That's right. So just to contextualize it, for services, we export, I think it's around 140 billion of goods to the US, which is more than double what we actually import from them. And it's things like financial services and PR and management consulting. It's those sorts of areas that are actually huge exports for the UK economy. Now, when we look at the goods side of things, the US accounts around 16% of our exports. It's often called our biggest market, and it is when you look on a country by country basis. But the EU, of course, acts as one block, and they take around 48% of our exports. So a far more important relationship, and one that looks like we are starting to improve upon as well, with potentially more sort of trade becoming a little bit closer there. But we hadn't really seen a lot of growth in our trade with the EU, whereas we had seen growth in our exports to the US. Now, the sort of areas which are important in terms of goods exports are, number one is cars, but it's actually luxury cars. It's things like your Bentleys and your McLarens. So you could argue that given there's already a very high price point on these goods, adding 25% to the buyer, maybe they'll still be willing to pay. They're certainly going to be less price sensitive than somebody buying a Nissan, for example. But actually, most of our mass market cars that are produced in the UK are actually produced for a European market. So a little bit of sensitivity there, but not to the same degree. Other areas that are potentially facing some disruption: machinery, transport equipment, power generation. So it's things like turbines, which are one example. Rolls-Royce is a manufacturer of turbine jet engines, and that they have a huge market in the US, but they're probably already looking at manufacturing there. Of course, that's the quickest way to get out of this problem. And then there's other companies as well involved in construction equipment and so on. So these are the sort of areas where investors are going to be focusing on in terms of trying to work out where those sensitivities lie. But I think it's important to recognize the US takes more than double the level of services that we actually import from them, which means that because that services are our most important export, it's going to be very difficult for us to retaliate, because if we did, they could stop taking some of our service goods, and that would be more damaging, to be honest.
Okay, great. Thank you. And I suppose then my final question would be, so listening to this, it just seems there's so much that, maybe we haven't experienced before. Things are changing so rapidly, literally day to day. How you keep up with it, I have no idea. So I guess, is there still a reason for a long-term investor to feel confident about what's going to happen moving forward?
Yes, definitely. There's a few things that I find really reassuring. And firstly, when I look at the hard economic data coming out of the US, it's still really strong. So, for example, disposable income is still growing month on month. That's because employment has held up very well. Wage growth is still at 4%, so outstripping inflation. So, whilst we have that strong jobs market, and although vacancies are a little bit lower with all of this going on, the number of job seekers is also lower. So that's kept that tension there to keep wages relatively high. So whilst we've got that backdrop, spending will continue. I think we're going to see a growth slowdown, but an outright recession is a long way from our view at the moment. We came into the year with 2.5% growth in the US. Yes, it will come down, but it still has to come down a long, long way before we're starting to talk about recession. So I think we can put that to one side for now. I think another thing that we can be a little bit reassured about is that the downside of globalization from an investment perspective was that markets became very, very correlated, and it was quite hard to find defensive areas when there was a potential growth slowdown happening. Now, it's not the same this time around. We saw the US down in the first quarter, but we also saw Europe up, UK up, China up. We've seen fixed income also contributing to portfolios. Alternatives have also done well. Gold up 19%, for example. So the backdrop that we have actually suits active managers who are diversified, not only on a regional basis, but also through the different asset classes too. So we do have a considerable number of tools in our back pocket for markets like this. And then the final thing I'd say is just that all of this disruption that we've had this year comes from the policies of one man. It's not even one party, it's one person. We have midterms coming up in 18 months' time, and I think any kind of economic weakness would really see the Republicans punished. So I think he's going to start to have one eye on the repercussions of continuing down this path. And then in the second half of this year, we're going to hear more on tax cuts in the US and deregulation. So we could yet see a reversal in markets. So on a 3-year view, which is the shortest time frame I would consider a long-term view, I think it offers investors a chance to buy into markets at a lower level. On a short-term view, in the next 12 months, there's still a great deal of uncertainty in there. So absolutely pay attention to the risk levels that you're sitting in at the moment and just be absolutely sure you're in the right one.
And any queries, as always, speak to your advisor.
Of course.
Lindsay, that's fantastic. Thank you so much for trying to help unpick so much of this noise. And actually just listening to you, it just strikes me, there are so many different lenses to place on this. It's not easy to try and reach a particular conclusion, just lots of things to consider when working out what's playing out. And obviously it's going to keep people like you and me certainly on our toes very much every day for the next few months. So thank you. We really appreciate it. As always, thank you for finding the time, and thank you for everything you've done today. Very much appreciated.
Been a pleasure. Thanks for having me.
So that's it for the latest Citrus Insights. Thanks for watching. Take care and bye for now.